The 2008 financial crisis, also known as the global financial crisis, was a severe worldwide economic downturn that began in 2007 and lasted until 2009. The crisis was triggered by a combination of factors, including the housing bubble in the United States, lax lending standards, and risky financial practices. One of the key drivers of the crisis was the housing bubble. Between the late 1990s and mid-2000s, home prices in the United States rose rapidly, fueled by low interest rates and lax lending standards. Banks and other financial institutions began to offer mortgages to people with poor credit histories, often with little or no documentation. These mortgages, known as subprime mortgages, were packaged together and sold to investors as securities. As the housing market began to cool off in 2006, the value of these securities began to decline, leading to large losses for investors. This triggered a chain reaction throughout the financial system, as banks and other financial institutions that held these securities began to experience significant losses. At the same time, many financial institutions had taken on large amounts of debt to finance their investments in these securities, making them vulnerable to a sudden downturn. As investors began to lose confidence in these institutions, they began to pull their money out, leading to a liquidity crisis. The crisis was further exacerbated by the failure of several large banks and financial institutions, including Lehman Brothers, Bear Stearns, and AIG. These failures led to a loss of confidence in the financial system, and banks became increasingly reluctant to lend to one another, further exacerbating the liquidity crisis. To prevent a complete collapse of the financial system, governments around the world took unprecedented steps to stabilize the system, including bailing out banks and providing stimulus packages to boost economic growth. The 2008 financial crisis had a profound impact on the global economy, leading to widespread job losses, reduced economic growth, and increased government debt. It also led to significant changes in the financial regulatory system, as governments around the world sought to prevent a similar crisis from occurring in the future. Some of the common reasons for a global recession can include financial crises. A financial crisis in one country or region can have a ripple effect on other parts of the world, causing a global recession. Reduction in consumer and business confidence. When consumers and businesses lose confidence in the economy, they may reduce their spending, which can lead to a reduction in economic growth and ultimately a recession. Global trade tensions. Trade tensions, such as trade wars, can lead to a reduction in global trade and economic activity, which can cause a recession. Natural disasters. Natural disasters can have a significant impact on economic activity, especially if they occur in regions that are critical to global supply chains. Oil price shocks. Changes in the price of oil can have a significant impact on global economic activity, especially if prices rise significantly. Pandemics. The outbreak of a pandemic, such as the COVID-19 pandemic, can cause a global recession by disrupting global supply chains, reducing consumer demand, and leading to widespread economic uncertainty. It's important to note that these are just some of the factors that can contribute to a global recession, and the exact causes can vary depending on the circumstances. Role of bank in financial crises. Yes, banks can play a role in a recession. Banks are key players in the economy as they provide credit and liquidity to individuals, businesses, and governments. During a recession, banks may become more cautious in their lending practices, which can limit access to credit and slow down economic activity. This can exacerbate the effects of a recession by making it more difficult for businesses to access the funds they need to invest and grow, and for consumers to access credit to make purchases. Additionally, banks can contribute to a recession through their involvement in the financial markets. Banks may invest in risky assets, such as subprime mortgages, that can lead to large losses during a downturn. If a significant number of banks experience losses, it can cause a ripple effect throughout the financial system and lead to a broader economic downturn. Finally, in some cases, the failure of a large bank can trigger a recession. For example, during the 2008 financial crisis, the failure of several large banks contributed to a severe recession as it led to a loss of confidence in the financial system and a reduction in economic activity. Overall, banks can play a significant role in a recession, both through their lending practices and through their involvement in the financial markets.